The big headline is Palantir got out of the gate, but its market cap today is below what it was on the private markets 5 years ago. Was a direct listing the right call?
Yes, the direct listing was the right way to go. I think this was a very successful listing, good debut in the public market. It came out at 13.9 times sales on a diluted basis and 10.5 times on a basic shares. I think it's valued very well, and it closed pretty in line with what Spotify and Slack did. So I think it was a success story all around.
Co-founder of Palantir, Joe Lonsdale, joined my colleague Eric Schatzker earlier today, and Eric asked the question, how could it be worth less, though, than it was 5 full years ago? Take a listen to what Joe Lonsdale had to say.
5 years ago in Silicon Valley, you had money pouring in from China, money pouring in from family offices. We go through these things in Silicon Valley where things are overvalued. 5 years ago, probably should have been valued at 8 to 10 billion, and it's I think today I think it's a great buy where it is now.
Yep.
Joe Lonsdale there. Santosh, how does that make you feel about your investment?
Yeah. So we know Joe very well. Well, I think 20 billion was really an outlier. It was really, I think, like he said, closer to 10 billion was the right way, and that's what you saw in the secondary markets. So, and we've been owners since very early, so our cost price is way low than what you're seeing now. So I think we're fine with that as far as that goes. I think overall, I think the big point now is Palantir has come together very well in the last 2 years, just based on their foundry product line really getting good traction, and they have a good sales pipeline, and they're executing very well. So I think that's what the big story should be, and they will be going forward. This is a good starting point off the gate. They're not ahead of themselves. They just need to start executing, which I think they will, considering their run rate at this point.
What about profitability, though? They're still not profitable. It's been 17 years. How important is that to you as an investor? Yeah,
I think the CEO, Karp, said this afternoon, actually, on CNBC, they've been investing. They put money up front. It takes a while to do something. They're almost 5 years ahead of the market. And so there's heavy upfront investment. So what's happened now is that in the last few years, the foundry product line is much less, needs less hand-holding, moves faster, the revenue recognition is faster. So I think what you're going to see in Europe already, foundry was driving profitability. So I think overall, I think they're very close. They have a line of sight to profitability. The revenue is growing very well. It's the closest to a plug-and-play, the foundry is, and the Gotham product is good for the government sector. So all around, like he said, 95% of the people, of the customers came back. They're sticking there. So there's a high level of stickiness in this whole product because they really go deep into the enterprises, map out everything, deep data mining, which is what we need at this point, with everything being so data-centric. So they're in the right spot. They're on the right side of the market. All they have to do now is just kind of get it together in terms of execution, which they are. They've cut costs quite a bit. They're adding sales force, which they never had. Only last year, they beefed up their direct sales force. So that should drive their customer base. So things are moving in the right direction. No reason to doubt their success down the road. Of course, execution is what we need, and we'll see how they perform. They're set up well, basically, off the gate.